I want you to imagine just for a second holding the reins to $45 billion.
Oh, wow. Yeah. That's a lot.
Right. Take a moment to really feel the weight of that kind of capital. Now imagine watching 35 billion of it just uh, simply evaporate in a matter of days.
I mean, a number that large almost stops being money for most people.
Yeah,
It
exactly.
just turns into this abstract math, like a figure on a spreadsheet that's honestly really hard to genuinely conceptualize.
It is. But for one person this week, it wasn't abstract at all. It was a very brutal reality.
Yeah, unfortunately for him.
So welcome to today's deep dive. We are unpacking a breaking CNBC article from today, July 35th, 2026 by Hugh Sun.
It's a wild story.
It really is. The focus is the spectacular rise and the truly mind-bending immediate collapse of an AI hedge fund called Situational Awareness.
Right, which was run by Leopold Aschenbrenner. He's this 20-something former researcher over at OpenAI.
The mission of our deep dive today is to unpack how a certified Silicon Valley prodigy flew so incredibly close to the sun. We want to figure out what his sudden downfall reveals about the massive frenzy surrounding this whole current AI boom.
There's a lot to unpack there for sure.
Because looking at the source material, Aschenbrenner feels like a brilliant architect, right? But he's an architect who spent all his time designing this towering, magnificent billion-dollar skyscraper.
Only to build the entire thing directly on top of quicksand.
Exactly. So I need you to help us figure out how someone supposedly smart enough to predict the entire future trajectory of artificial intelligence could be so, well, totally blind to basic market gravity.
Yeah, well, the answer really lies in how Silicon Valley assesses risk and, how it rewards hubris, honestly.
Right.
To understand the sheer scale of this financial crash, we have to look at the undeniable intellect and the highly controversial background that convinced some of the smartest people in tech to just hand a 20-something the keys to a financial empire.
Because you don't get access to that kind of capital without a serious backstory.
No, definitely not.
And his background is undeniably unique. I mean, he was born in Germany, skipped multiple grades in their school system, and graduated high school at 15.
Which is already crazy.
Right, and then he heads to Columbia University and graduates as valedictorian at age 19.
A literal teenager delivering the valedictory address to a graduating class of Ivy League students.
It's insane. But what stands out in the sources is how he views his own intellect. In podcasts and interviews, he attributes his success to what he calls his intellectual weirdness and his disagreeableness.
Yeah, he claimed that German culture punished those traits, but he saw them as his superpower.
Right, but there's a fascinating quote in the CNBC article from his Columbia salutatorian classmate, Sophia Montrone, that paints a very different picture.
Oh, yeah, I love that quote. Montrone didn't even know who he was until right before graduation.
Wait, really?
Yeah, she met him over Zoom and said, it was not like he was some prince emerging out of the school, he was just some guy.
Just some guy.
Exactly. And she went on to describe him as socially awkward and childlike.
See, just some guy is quite the contrast to that lone genius mythos that he's got going on.
It really is.
And this is where I struggle with the whole prodigy narrative that Silicon Valley bought into so heavily. Because when you look at his resume right after Columbia, it reads like a literal bingo card of the most spectacular tech scandals of the last decade.
Oh, absolutely. His career path maps perfectly onto the major fault lines of the tech industry's recent history.
Right. So first, he co-founds Columbia's effective altruism chapter.
Which is a huge deal in tech.
Yeah, let's pause there for a second because effective altruism is this philosophy that's incredibly popular in Silicon Valley. Yeah. It basically argues you should use data to optimize doing good.
And that usually means making as much money as humanly possible so you can give it away.
Exactly. So that network funnels him directly into working under Sam Bankman-Fried at the doomed crypto firm FTX. Aschenbrenner was literally helping run a charity out of an FTX penthouse in the Bahamas right before the entire company went up in flames for massive fraud.
Just incredible timing.
And then, if that wasn't enough, he lands at OpenAI on their super alignment team under Ilya Sutskever.
Which, that is arguably the most sensitive problem in the entire tech sector right now.
Explain that for us.
Well, super alignment is the branch of AI research dedicated to ensuring that if we ever build an artificial superintelligence like a machine vastly smarter than humans, it actually stays aligned with human interests.
So it doesn't decide to turn on us.
Exactly. It's high stakes.
Yeah.
But his tenure there ends in total disaster.
Right. He gets fired from OpenAI in 2024.
Yeah. He had written this memo to the board warning about Chinese espionage and foreign threats, claiming OpenAI's internal security just wasn't strong enough.
And then the company accused him of improperly sharing confidential information, right?
Right. Now, he disputes that, obviously. He says he was just raising legitimate security concerns.
And to be fair, he even had prominent defenders. Like computer scientist Scott Aronson argued Aschenbrenner was just trying to do the right thing, and that leadership vastly overreacted.
Sure, but think about this. If you take that resume to traditional Wall Street featuring proximity to the FTX collapse and a messy, highly public firing from OpenAI over confidential info,
You get laughed out of the room.
you get laughed right out of the room. It looks incredibly radioactive.
So how does a history of being adjacent to massive corporate failures and security scandals become a selling point for managing billions of dollars?
Well, because in the specific echo chamber of Silicon Valley, those are not red flags.
What are they then?
They are battle scars. The Valley has a very, very specific archetype for the visionary founder. Being a weird, disagreeable genius who gets fired for supposedly speaking truth to power.
That fits the mold perfectly.
Exactly. It signals that you are an independent thinker who isn't constrained by traditional corporate bureaucracy. Investors out there are essentially looking for rebels, not rule followers.
And the ultimate proof of that rebel status seems to be the manifesto he dropped. Like, the catalyst that wiped away any lingering doubts about his capability was a 165-page viral essay he published in June 2024.
Titled Situational Awareness.
Right. Just weeks after being pushed out of OpenAI, he publishes this sprawling document.
And the core argument was bold. He was saying that artificial general intelligence AGI, meaning AI that can match or exceed human capabilities across all cognitive tasks, was coming in a matter of a few short years.
Not decades, like a lot of people thought.
Right, not decades. And he argued that global governments were totally underestimating the sheer pace of this progress.
He really positioned himself as one of perhaps a few hundred people on the entire planet who actually grasped what was about to happen.
Oh, completely.
He wrote, "If they're seeing the future even close to correctly, we are in for a wild ride." That kind of language, I mean, it doesn't just present a theory, it positions the author as a modern-day prophet.
And that exclusivity is incredibly intoxicating to investors. Everyone wants to be in on the secret. So he took this massive, dense theoretical framework and weaponized the ensuing viral fame astonishingly fast.
Because a 165-page PDF doesn't spontaneously generate capital on its own?
No, but the hype it created allowed him to walk into the offices of absolute tech royalty.
It really did. By July 2024, almost immediately after the essay drops, he raises $225 million in seed capital to launch his hedge fund.
Which he also named Situational Awareness, naturally.
Naturally. And the names of the backers are staggering. Patrick and John Collison, the co-founders of Stripe.
Right.
Nat Friedman, the former CEO of GitHub. Daniel Gross, a major tech investor. And these are serious, seasoned players.
And they are handing a 20-something with zero professional money management experience $250 million.
How does that even happen?
Well, they were applying venture capital logic to a hedge fund.
Meaning what exactly?
In venture capital, you bet on the smartest engineer in the room, knowing that 9 out of 10 startups will fail, but the one that succeeds will pay for all the losses 100 times over.
So they treated Aschenbrenner like a startup founder.
Exactly. And for a brief window, it looked like the smartest bet in the world.
Oh, it really did. From July 2024 to early July 2026, the fund's assets surged from that initial $225 million up to $45 billion.
That is just an astronomical jump.
The Wall Street Journal reported they had racked up gains of over 1,000% since inception. If you're an investor looking at those numbers, you're entirely convinced the kid is a prophet.
You'd have to be. But let's look under the hood of that $45 billion, because the structure of the fund is where the fundamental flaw was hiding.
Okay, lay it out for us.
According to the CNBC reporting, about 1/3 of the fund was locked up in private companies. This was dominated by a massive multi-billion-dollar investment in Anthropic, which is one of the leading AI labs.
Right. The remaining 2/3 of the fund, however, was in long and short public equities. And for anyone listening who might be unfamiliar, that essentially means playing the traditional stock market. Betting that certain publicly traded companies will go up in value, which is a long position,
Right.
or betting they will go down, which is a short position.
Right, but the invisible trapdoor wasn't the specific companies he was picking, it was the mechanism he used to buy them.
The leverage.
Yes, the fund was operating on a reported leverage of up to 400%.
Okay, Walk us through the actual mechanics of 400% leverage. How does a fund use that to turn a good trade into a 1,000% gain, and why is it so incredibly dangerous?
Sure. So leverage is just borrowed money. 400% leverage means a 4-to-1 ratio.
Okay.
For every $1 of actual cash you have, you borrow $4 from a prime broker, usually a massive bank.
Right.
So if you have $100 million in client capital, you borrow $400 million, allowing you to buy $500 million worth of stock.
You are massively multiplying your exposure.
Yes. If that stock goes up 20%, you don't just make 20% on your original $100 million. You make 20% on the entire $500 million, which is $100 million in profit.
Wow.
You just doubled your actual money in a single move. That is how he hit those 1,000% returns so fast.
But the math swings both ways.
Oh, definitely.
To make sure I'm picturing the scale of this risk accurately, it's like buying, say, a $500,000 sports car.
Okay, good analogy.
You put down $100,000 in cash, and the bank loans you the other $400,000. You get to drive the car, but the bank technically owns the vast majority of the asset.
That is the exact dynamic. And because the prime broker owns so much of the risk, they monitor the value of that asset continuously.
So if the Kelley Blue Book value of that sports car suddenly drops by 20%, the car is now only worth $400,000.
Right.
The bank looks at the math and realizes the asset is now worth exactly what they loaned you, meaning your initial $100,000 equity has been completely wiped out. You own nothing.
That is the terror of 4-to-1 leverage. A relatively minor 20% dip in the market completely obliterates 100% of your actual capital.
That's terrifying.
It is. In public markets, leverage isn't just about how high you can climb, it's a test of how much pain you can survive on the way down.
And the moment the bank sees that dip, they issue a margin call.
Exactly. The prime broker effectively calls you up, or more accurately, their automated risk systems trigger, and they say the value of your collateral has fallen.
We need our money.
Right. You need to wire us more cash immediately to cover the gap between what the asset is worth and what you owe us. And if you don't have the cash, they have the legal right to seize the assets and sell them off at whatever price they can get.
Just to recover their loan.
Yep.
Which brings us directly to the rapid, violent disassembly of the Situational Awareness Fund. Because the shocking part to me is that it wasn't some massive systemic economic crash that took him down.
No, not at all. It was a very ordinary market event.
Just a normal Tuesday.
Seriously. Semiconductor stocks, which are, the backbone of the entire AI trade, they just started tumbling in a regular rotation. Institutional investors were moving their money out of tech and into other sectors for a few weeks.
Just normal rebalancing. The CNBC article points to hard-hit names like SK Hynix and CoreWeave. These are the companies physically manufacturing the chips and providing the massive cloud computing infrastructure that makes AI possible.
Right, and Brenner was heavily leveraged into these exact names.
So when those stocks dipped, the 400% leverage acted like an anchor, dragging the fund underwater instantly.
And Brenner didn't have the spare cash lying around to satisfy the mounting margin calls from his prime brokers.
So he was forced to liquidate.
Yeah, he had to sell off his public stock bets in a massive fire sale just to pay back the banks.
And who was on the other side of that fire sale? The buyer swooping in to pick up all these high-tech AI assets at a sticking discount was Ken Griffin's Citadel.
The irony there is incredibly thick. Citadel is the quintessential, old-school, traditional Wall Street behemoth.
Exactly. You have the Silicon Valley AI prophet, the guy who convinced everyone he was the only one capable of seeing the future, getting completely dismantled by a traditional Wall Street firm.
It's almost poetic.
It is. Citadel didn't need a 165-page manifesto about the future of humanity. They just sat there, waited for an over-leveraged kid to run out of cash, and bought his assets for pennies on the dollar because he didn't understand the present.
Yeah, there is a quote from the article by Jerry Dial, a Wall Street coach, that captures this perfectly.
What did he say?
He noted this blow-up was a matter of not if, but when. Dial pointed out that Brenner might be entirely correct about the ultimate trajectory of AI in the long run.
Sure.
But public markets don't care about the long run if you run out of money today. You have to survive Tuesday to get to the future.
That's a great way to put it. So does a $35 billion wipeout mean his underlying theories in the manifesto were completely wrong? Or is this just an expensive math error?
It is entirely a failure of risk management, not necessarily a failure of technological foresight.
Okay, explain that.
You can be 100% correct that SK Hynix or CoreWeave will dominate the global economy over the next 10 years. But if you borrow 4 times your capital to buy their stock today, and the stock drops 15% tomorrow, you are bankrupt.
Before you ever get to find out if your 10-year prediction was right.
Exactly. He confused technological inevitability with financial invulnerability.
And the personal timing of this harsh reality check adds an intensely dramatic layer to the whole story.
Oh, it really does. So the fund currently sits at roughly $10 billion, down from its peak of 45.
Which is still a huge number, but a massive drop.
Right, and that surviving capital is largely the illiquid private investments, like Anthropic, that he couldn't easily sell off. But this grueling week of margin calls and forced liquidation is happening on the exact same weekend as his wedding.
Wow. And he is marrying Evidal Balwit, who serves as the chief of staff for Dario Amodei, the CEO of Anthropic.
Yeah.
Anthropic, again, being the massive private investment, making up a huge chunk of his surviving fund.
It really highlights the extreme insularity of this world, the massive sums of money, the sweeping manifestos about the future, the personal relationships.
It's all connected.
Yeah, they are all circulating within a tiny ecosystem of a few hundred people in Silicon Valley.
This saga illustrates the profound danger of that echo chamber, I think. Because when everyone in your immediate circle is telling you that you're a visionary, you're all reading the same essays and you're all attending the same weddings, you lose sight of the outside world.
You lose respect for basic unyielding rules like financial leverage.
Exactly. Having a brilliant technological vision does not grant you immunity from the mechanical rules of the real world.
No, it certainly doesn't.
And think about the resume we discussed earlier. Aschenbrenner literally worked on the superalignment team at OpenAI. His entire job was dedicated to safety.
Right. The mandate was to figure out how to put guardrails on superintelligent systems so they don't spiral out of control and destroy us.
Yet he leaves that job and immediately builds a $45 billion financial machine with absolutely zero safety guardrails.
It is a stunning psychological blind spot. I mean, he spent years obsessing over how to align artificial superintelligence with human survival, but completely failed to align his own portfolio with basic risk metrics.
It's wild.
He built a system that required absolute perfection to survive, and, markets are never perfect.
So how do people listening to this protect themselves from getting swept up in this exact same hype cycle? When an everyday investor is looking at the AI boom, trying to decide where to allocate their time or their savings, what is this shield against this kind of hubris?
Well, the shield is learning to separate the fundamental technology from the investment vehicle.
Okay.
You have to ask yourself, am I investing in a genuine technological shift? Or am I buying into someone's highly leveraged, hyper-risky vehicle that is just riding the hype?
That's a crucial distinction.
Aschenbrenner's story teaches us that you can be holding a winning lottery ticket. You can be totally right about the future of AI, but if you buy that ticket with money you borrowed from a bank, you still lose everything when the loan is called in.
Yeah.
You must always look at the structure, the leverage, and the margin for error.
Wrapping up this deep dive, the core tension we've explored today is just a fascinating case study in hubris. We have a certified intellect, a 24-year-old who offered a viral manifesto on the future of AI, who successfully convinced the smartest people in tech to hand him $250 million.
And he leveraged that into a $45 billion empire.
Only to watch $35 billion of it vanish in days because he built his skyscraper on the quicksand of 400% leverage. It perfectly illustrates the chasm between seeing the future of technology and actually surviving the volatility of the present.
Now, to be fair, he still manages $10 billion, and he may eventually rebuild from there. But the aura of absolute invincibility that Silicon Valley wrapped him in, that has been completely shattered by the reality of the public markets.
That leaves us with a final thought to mull over as we close out. Aschenbrenner's entire thesis, the central argument that made him famous, was that global governments are dangerously underestimating the rapid, uncontrollable pace of artificial intelligence.
Right. He warned that society is fundamentally unprepared for the risks of AGI.
But given his own catastrophic miscalculation of market speed and his total blindness to the basic mathematical dangers of financial leverage, it begs a much bigger question for you to consider. If the self-proclaimed prophets of AI cannot even foresee and manage the basic, predictable risks of today's stock market, why should we trust them to manage the existential risks of humanity's future?